30-year mortgage rates hit 7.29% ahead of today's Fed meeting. Welcome to Market Insight. I'm David Pollard. The Federal Reserve is widely expected to keep rates unchanged later today. And while inflation remains sticky and the job market remains tight, the housing market remains under strain with no end in sight to pressure on mortgage rates. Data today showed the rate on the average 30-year fixed rate was 7.29%. Well, to discuss how this is impacting the economy and housing market, I'm now joined by Odeta Kushi, Deputy Chief Economist at First American. Welcome, Odeta. Many thanks for joining us. Let's look at the big question today. What do you expect from the Fed this year and why?
Well, the Fed thus far seems to be taking a wait-and-see, higher-for-longer approach. And that's really because in their dual mandate of stable inflation and full employment, the full employment piece is going quite well, whereas the inflation has proven to be stickier than expected. And so the Fed is really sort of monitoring those risks and looking to keep rates unchanged, likely at today's meeting, and maybe even only one or two rate cuts in the second half of the year at most at this point is what the market's telling us.
Now, Jerome Powell is known to be very guarded in his comments, usually at his press conferences. What do you expect he'll be saying today?
I think the markets are looking for Powell to give any insight into the trajectory of monetary policy for the remainder of the year. But I think that Powell will stick to the script, maintain a data-driven stance, and really highlight that it's all about the incoming inflation and labor market reports. That will really drive the Fed's decision from here on out.
Now, amidst all these worries over inflation and high rates, the US consumer has remained remarkably resilient. Do you expect that to go on like that? Can the US consumer keep on being so strong?
Well, U.S. consumer spending is the bulk of economic growth in our country. So the health of the consumer is everything. Now, the labor market remains robust, so that works in the favor of the consumer. They're gainfully employed, wages are increasing, but certainly there are headwinds. I mean, excess savings have declined significantly. That savings cushion that's been robust is dwindling, and so that's a headwind. And the consumer is taking on more debt to finance that spending. So there are certainly headwinds for the U.S. consumer for the rest of the year.
So what does that all mean for the housing market? Are things looking a little bit better this year or a little bit worse?
The housing market is so interest rate sensitive that this higher for longer mortgage rate environment really impacts the seller and the buyer in the housing market. The seller is rate locked into historically low mortgage rates. And so as rates drift higher, they lose the incentive to sell. And then the buyer, of course, with higher mortgage rates faces lower purchasing power. Now, with that said, the decision to buy and sell and transact is more than just a financial decision. There are lifestyle decisions that come into play as well. And we do know that the largest generation in U.S. history, the millennial generation, continues to age into their prime home buying years, continue to age into these key lifestyle decisions that are highly correlated with buying that home. So we'll certainly see those buyers still try to get into the market. And of course, sellers who have held off listing their homes over the last 2 years will also feel the need to enter the market for lifestyle choices as well. And so we'll still see transactions. We're seeing higher listings in the market, so we might see an uptick in activity, but certainly higher for longer mortgage rates dampen any momentum in the housing market.
So would you care to put a time frame on when the housing market might normalize amidst all those lifestyle decisions that you've just mentioned?
I think there's still quite a bit of demand on the sidelines. And so this year will still be sort of a year of transition. We still have a lot of uncertainty about the future of the economy and monetary policy. And so, we'll start to get more used to the idea of higher mortgage rates and the market will adjust. So I think this year will be a year of transition, but I'm cautiously optimistic about next year.
Okay, Odeta, we'll leave it there. Odeta Kushi, Deputy Chief Economist at First American. Many thanks for sharing your thoughts with us today. That is your Market Insight. You can watch more videos on Reuters.com.